All right, everyone. So now as we move into our part three of our Q4 update here, we're going to talk a little bit about looking forward in 2026, what we're seeing out there, some of the things we have teed up for the first quarter, and then talk a little bit about the acquisitions plan, operations plan, some highlights here at URS Capital Partners. So first off on our new development, the Ash. We have received our final TCO on our largest building, and I think the big goal for this year is to get the project closed out over the next several months and obviously continue to work towards stabilization. Going into the final building, which is roughly
194 units.
194 units. Yeah. It's a massive building.
It's a big one.
We went into it, though, pretty much 95% leased on what was available prior to that, which was our goal. So the team's done a great job working through the winter and slower season, continuing momentum. We're ramping up for a big grand opening in May, which we'll put out publicly. We'd love to have anybody who's in and around the market to come see it. It's truly a very, very special property.
Yeah, look, I'm really pleased with the leasing momentum through the winter too. And now that we have this final CO, there's so much more product available, and it's so much easier to lease units when you can actually show the unit that a potential resident's going to move into. So really looking forward to the next 30, 60 days as the weather starts to turn and we enter spring leasing season. Continued momentum on the lease up side at the Ash. Think next on the looking forward side, big announcement. As of recording the video, we are officially closed on our latest acquisition in the Nashville MSA in Rutherford County, Murfreesboro. This is a early 2000s vintage. We bought it off market, direct from the developer. The third generation has been managing the property for the last couple of years. We made the relationship probably 2-3 years ago. We helped them through a refinance, established lines of communication. So we were able to establish a relationship so that we're in a position to get the call should they ultimately sell, which is what happened. So really excited for another acquisition in Murfreesboro. We own Cobalt Row and Farmhouse Apartments, so we have a strong presence in the market. So there should be good efficiencies there across the three deals as we look to continue to grow throughout the Nashville MSA.
Yeah, I think this one's been a labor of love for several years, to say the least. And, it's a generational property, first time ever sold outside the family. So it's exciting for us. It gives us nearly 600 units of market rate, not counting Cobalt Row.
Not counting Cobalt Row.
Not counting our student housing property within 10 minutes of each other. So, as reference, it should pick up some efficiencies. We've been working on this contractually for almost 6 months now. So to get it done, to accommodate the sellers for closing in 26, we're excited to kick the year off and add this one to the portfolio. So we're also excited to add our first property back into Atlanta, our reentry back into the market. It's something we've been making a conscious effort over the last, basically probably now 14 months. We've underwritten and offered on several deals in and around Atlanta. This one is great property, good size, late 90s vintage, 1999 construction, 240 units, full amenity package, gym, pool, clubhouse, great grounds, great property. It's something we started working on back in November, and more operational distress on this one than physical. So I think it's running around 15 to 20% economic vacancy, just given the seller situation and liquidation that they're going through. Property operations kind of took a dip over the last year. And we really believe, just given our knowledge of the submarket and the other deals in and around it that we pursued and weren't able to get to pricing on eventually, we had really good submarket intelligence. I mean, 2 of the 3 comps we've underwritten and offered on. Mm-hmm. So we knew the area very, very well. And there's no reason this property shouldn't be performing in the 90-95% range within the next first 6 to 12 months of takeover. So that should be closing here in the next couple of weeks. And between the 2, it'll be a little over 500 units added to the portfolio, and a great start to the first quarter. So as we look beyond kind of the first quarter here and, focusing on our acquisitions and operational plan, It's pretty much more of the same. We started actively acquiring again the beginning of January of 2024. We've been very consistent. I think acquired about 3 to 4 deals per year since the beginning of 24, and we have similar plans for this year. The market continues to, present some very attractive spots for acquisitions at really attractive bases relative to historical values and replacement cost, and we're maintaining our discipline as we move into 26. It's more of the same. We don't expect operations to take off like a rocket ship this year. We know it's going to continue to be challenging, but we also know that there's still a pretty significant dislocation in the market and lack of liquidity on a mass scale, uh, given the uncertainties that are out there. So from an acquisition side, why don't you talk a little bit about what our plans are and what we're seeing out there?
Yeah, I think it's a lot of the same that we spoke about last quarter. We're seeing more and more motivated sellers as loan extensions expire and capital stacks are reset. I got a call in the other night on 3 deals that the seller now, I mean, they don't really have a choice. These are assets we've been tracking for 2 years.
Yeah.
So this is not like a lot of the headlines are, this is not this mass distress situation like a lot of people thought might come, but that's not to say that there's certainly distress in the markets that we're looking at on a more of a
Yeah,
one-off
there's
basis,
pockets of it.
pockets of distress. Um, exactly. So we're seeing that, but this is not something where you get the call and you move in 48 hours. This is something that we've been tracking these loan maturities since
Hmm.
2023. I mean, we saw the writing on the wall. We built out our pipeline. We've been making calls, whether it be direct to owner, to lender, to brokers, and been tracking these deals. And in the last 3 to 6 months, we're getting that feeling. A lot of these are now going to start to come to fruition
Yeah.
because the time is up.
Yeah, and I think I referenced that earlier, right? It's you're now beyond, as you said, the extension periods,
Yeah.
and nothing's really changed in
Yeah.
the environment, right? Rents have not grown, interest rates have not come in materially on fixed rate debt, expenses have not come down meaningfully,
Hmm.
across the board. So it's just very simple. Time is running out, right,
Yeah.
on those operators that had maturities that were over levered, some aggressive business plans, and I think it's really up and down the food chain to some extent, right? You have different baskets of motivation, and I think for us, it's we're opportunistic by nature, and I think that's been one of our strengths, for the last 15, 16 years, is that we can play up and down the food chain. So we'll see everything from, a smaller development shop being forced to sell because on the surface it doesn't look like they're over levered because they have a bank loan at 65%, but they took on 25% of preferred equity,
Hmm.
back in 2021. And now that property is still not stabilized or bouncing around 85 to 90%. And the preferred equity is now coming to the table saying, hey, we want a sale. We want our capital back. We want our return back. We don't care that your equity is going to get wiped out or you're not going to hit your promote. So we're seeing spots of that, not on a mass scale. I think those are kind of fewer and far between, but we're seeing more of it than we've seen in the last 3 years.
Yeah.
And then you also have funds that are at the end of their life cycle.
Yeah.
They've exercised their maturity. Maybe their fund was maturing in 23 or 24. It was a 7 or 10 year fund, and they've exercised their 1 or 2 year extensions, and now they're just forced to sell into this market because contractually and legally they're bound to, as per their fund documents, where they might have been more willing to wait, but they can't. So you have that. You have some of these private sellers or long-term owners that are just in a place where they have equity in their deals. They've owned them for 10, 12, 15 years. Some instances, 25, 30 years. And they're just at a point, whether it's a personal situation where, hey, it's time to sell, and they're selling into an environment that's not very accretive. There's not a ton of liquidity out there, depending on the profiles of deals. You have lenders that are being a little more, I wouldn't say aggressive, but willing to take the keys back. They obviously want to try to do what they can to salvage their debt basis. But that's where the discipline here, maintaining discipline while being long term greedy really comes into play because we get more of these profile, I'd say, like the 70s, 80s, 90s vintage bridge deal that was done in 21, 22, where it's okay, the owner and the sponsor and the equity is blown out, and the lender's like, okay, we'll sell it at the debt basis.
Hmm.
But the problem is the debt basis doesn't make sense.
Yeah.
Where the story sounds great, right? Everybody loves that story, but we're finding more of those where it's like, okay, great, we understand that your debt basis is maybe 175 a unit on this deal, but we're at 140.
Yeah.
And if you want to, transact or be creative, this is where we're at. And I think we're seeing more of that come to the table as of late. Uh, it's just it's a very dislocated. I know we use this word a lot, but it's a dislocated market, and that's where our discipline and our processes on the underwriting and the pipelines and the follow ups. You're right. I think the two deals that came in, the other last night or the night before,
Hmm.
were deals that were in our pipeline 2 to 3 years ago
Since 2023.
with the same story.
Mhm.
Oh, the lender will sell at their debt.
Yeah.
Now
Yeah.
it's
Yeah.
now it's okay. The lender's taking the keys back, and they might be a little more willing to negotiate.
Yeah, no, 100%. I agree. We're starting to see opportunities where the lender realizes it's not worth their debt anymore, and they're willing to come to the table and have those conversations about selling, at some number less than par.
Yeah, absolutely. Um, So on the other side of it, that's the acquisition side. That's the fun part, right? Is the hunt. And, as Chris touched on part one of this in our pipeline, we probably got through 250 plus deals, give or take, on the underwriting side,
Yep.
to get to the two deals that actually closed in 25, right? We had Palms and Towns closed in
Palms and
25.
Towns closed in 25. Yeah,
Yeah.
we're just over 200 deals that we brought in the door
Yeah.
in 25.
And, that's just being patient, staying close to the market. And then you have on the operations side, we referenced earlier when I was going through the KPIs that we made a really meaningful push, I think, into our operations in the last 12 to 18 months. And I'm super proud of that. Everybody at Urso Properties, what we've accomplished during a really tough time operationally. We've not been shy about letting our investors know on all the deals that we bought since the beginning of 24. My view is not that the market, the operational market was going to improve materially in 24, 25, or 26. We bought these assets because we felt that they were a really attractive basis. They were markets we wanted to be in for the next 10 years. We felt that they were assets that we wanted to own for 10 years, and we were capitalized appropriately to do that for 10 years. We believe that 26 is going to be, a continued, I don't want to say challenging environment, but there's glimpses of things beginning to improve, but it's not going to be an easy operational environment. I think we still have some supply to be absorbed. We are seeing deliveries come down, as you touched on earlier, materially, which is the key. And that's been our thesis, is to buy good assets, capitalize them, operate through this period of, murkiness, for lack of a better way to put it. And we think we will be rewarded, come the second half 27 through 2030 as that supply story really goes away. And, if you look back, even with the flat to negative rent growth, I had this conversation with one of our brokers this morning at Cushman. I said, I bet you turn around, everybody wants to forget that we got 15 to 20% rent growth in 21 and 22.
Yeah.
And all everybody's talking about is, the flat to negative 1%, 2%, Austin 4%, rent declines over the last year. Average that out, we're right around in almost all of our markets, major markets, between 3 to probably 4% average rent growth per year since 2021.
Yeah.
And that's with 3 years of battling 50-year highs in supply. So we really do believe that normalization is around the corner. We're seeing it in some submarkets quicker than others. But in the near term, over the next 12 months, we want to continue to take advantage and keep buying until the market tells us otherwise, because the liquidity vacuum will open up. And as soon as investors start to see 2 consecutive quarters of positive rent growth, which is inevitable as supply is absorbed, demand has remained relatively healthy. Knock on wood, the economy's held up relatively stable. Uh, when that happens, you're going to see these billions of dollars that have been raised over the last 2 years begin to get deployed. And when the first big institution makes a splash, typically the second and third follow fast. And at that point is then, kind of the dislocation starts to be pulled out of the market, and the market starts to become a lot more efficient.
Yeah, and I want to make one point too on the rent growth side. I think 26 and likely 27 too is largely going to be the year of the operator, right? I think one of the most important parts of our business here at Earth Capital is we find broken real estate and we fix it, right? So whether that's a capital issue, a physical issue, a management issue, and often it's a combination of two or three of those issues, we're identifying properties with real problems and then executing a plan to solve them. And you can do that in any environment. We don't necessarily need market momentum to execute our value add business plans. It certainly helps with when the market's moving in your favor, that 15, 20 IRR turns into a 25 or a 30. But it's important to note that when you're identifying the types of deals that we are with problems, we can still execute our business plan even in a flat market rent growth environment. An example is Creekside, Asheville. We bought
Yeah.
186 units 13 months ago. We've moved rents over 15% in 1 year. Belmont Heights, we bought in January of 2024. We've moved NOI 40% in 2 years, over 20% per year. Even though those submarkets, if you look at the market rent growth, they've been between -1% and
Yeah.
1% over the last 2 years, but we're still driving NOI by executing our business plan. So I think it's just important to note that this year it's all about operations and it's identifying the opportunities where there's a real value add, there's a real mark to market story. And if we can execute our business plan, we can do that through any market environment or through most market environments, I should say. And then when the supply does taper off and we start to get into an actual market rent growth in the positive scenario, it's only going to help fuel the fire and help our momentum as we continue to buy these assets.
Absolutely. Well said. I think one of our old investors and buddies used to say, everybody can go buy a deal, not everybody can go operate a deal.
Right.
Or it's easy to buy a deal, it's not easy to
Yeah.
operate them, right? And that's what, listen, we all love the hunt of a deal. That's the reality of it. But I think the reason we've invested so much time, energy, and capital into Earth's properties over the last 3 years is because that's what drives long-term value
Okay.
is operations, right? I put out something, I think yesterday on LinkedIn that, we all want to buy below replacement cost, 20, 30, 40, 50%, but it's you have to have the staying power to be able to navigate through periods like this in the cycle that are inevitably going to come up, and you will be rewarded over the long term. I think, again, it's easy to go out and say, I want to buy deals, but to go out and be able to operate through an environment where you're not getting anything given to you in the form of operations, whether it's rent growth or NOI growth, having
Mhm.
to earn it day in and day out is something that we're really proud of. And it doesn't come without challenges. We're not immune to those challenges
No.
by any means. But I think it's how you respond to them and how attentive you are to them before they can spiral into something that is really material,
Yeah.
and being ahead of that. So kudos to our team at Urso Properties. We have a couple of highlights we want to wrap up with.
It's a good segue.
Want to highlight our boy Tommy D, who's celebrating his 1 year anniversary at URS Capital Partners, and he's had a direct impact on that progression we've seen at URS Properties and at the property level, coming in and really just owning his position on the asset management side and development side, assisting Mike in some of our developments, but most importantly, just taking, literally, I'm not even going to say daily, hourly ownership of the portfolio. He's been a tremendous addition to the team, and it's exciting to see him continue to grow and learn, and his enthusiasm to be a part of this and work with our team at Urso Properties so smoothly, I
Yeah.
guess, and genuinely to really produce the results that we've been able to get in the form of occupancy and NOI growth through another challenging year. In addition, we're making another tech investment here that we started with one of our investors. One of our investors started the firm Lobby CRE AI, but it's basically an AI platform that's bolting on to our entire portfolio. So everything associated with our deals is being uploaded into this LLM, essentially, that's catered to just Urso Capital Partners. So when I say everything, that's every bit of financials is being pulled from our operating system at Yardi, all of our loan documents, all of our quarterly reports, everything is centralized into this LLM and it's updated daily. And we're able to now go in there and utilize it to just, hey, I want to see a quarter over quarter summary on Belmont Heights. And it will extract that from our sphere. Give me a summary of all loans that are maturing in the next 12 months. That gets pulled right out. When is my interest only burning off? What are my payoff costs if we want to sell a deal or refinance it? So it's going to be a great tool, not only for us on the asset management side, but also our regional manager, our COO, and eventually our site teams are going to have the ability to leverage it for property level reporting on a daily and weekly basis. In addition to that, I've probably been more annoying than everyone would like to hear about the importance of AI in our shop. We are not an institutional shop. We don't proclaim to be, but we like to believe. I want to believe. I think we're doing a really good job implementing AI. Copilot on the internal level has been. We're a Microsoft shop, forcing the teams to learn it, to understand it, leverage it however we can to help streamline, every part of our process and enhance the experience for, our residents, our investors, and for our team to be able to continue to grow. And on that note, speaking of growth, we had another great addition to the team.
Yeah. So Samantha Ridgway, our one of our latest hires, is director of marketing. I mean, Samantha has been great. Talk about just starting and hitting the ground running. The value add she's had on the marketing side has been unreal, from launching all of our advertisement campaigns, PPC, our SEO, building out our property websites, jumping in on the new development side, whether it be for the Ash or Cypress Point, building out the website there, which is especially important in a lease up. Samantha joins all of our asset management calls. She's running our internal, Urso Properties group chat, and very active, really instrumental in building just culture and collaboration across properties. So I couldn't be, more proud of everything Samantha's done in such a short time, and I can't wait to see the runway ahead for her in 2026 and beyond.
Yeah, really a great addition. I mean, it's allowed us to kind of phase out what we've historically had to have third-party consultants for some of our takeovers and new developments on the marketing side to run that process. So, and I think you touched on, what doesn't get seen by the public or our investors is kind of the internal benefits of all these great people and technology. Just the culture that's being created is like we've never seen before across our properties, right? It's not an easy company structure, right? Property management, to create a culture, because you have two site teams in Nashville, two site teams in Charlotte, a site team up in Portland, Maine, soon to be in Atlanta, and Rock Hill. So we don't have everybody in one office every day. And, Jen has really led the charge on that. But, just having a company-wide, chat where there's competitions, everybody's sharing, wins and challenges and questions, and Sam putting together the weekly highlight newsletter where, she's calling out the top 5 for this and, the lead manager for that. It has such a tremendous snowball effect that, I think we're seeing the results of that in the form of, the strength of our operations. And again, that business never comes without a challenge every day. And, but having Jen, having Molly, Sam, Jamie, Katie, Leslie, Haley, George, Michael, and all of our amazing, community managers and service managers that often go unnoticed, it's great to see the longevity of our employees starting to take shape, where, we're celebrating a lot more 1, 2, 3 year anniversaries, every month basically that goes by. So.
Yeah, it feels great to be able to have so much confidence in the leadership team on the Urso Property side. And that gives us so much more confidence when we're looking at new markets, when we're looking at new deals, and we have to expand. Knowing that you have the people you can rely on to do so makes all the difference.
All right. So please, we're wrapping up the part 3 of our Q4 update, but please go to our YouTube channel. This is where we're housing all the content that we're putting together. We also do a lot of drone videos of our properties to share with our investors in those projects, but we're putting them up there publicly so people can see the progress, the transformations that happen. Follow us on all the socials, LinkedIn as well. You see our profiles are there, Instagram, Facebook. Would love to kind of hear from you. And, finally, just want to thank all of our current investors. I didn't get too deep into it on this quarter's update, but as I referenced, we have over 300 active investors. We've been extremely fortunate over the last now 2.5 years to raise probably north of $150 million, where other shops are struggling to raise capital for one deal. We can't express enough our gratitude and appreciation for the loyalty and the shared sentiment and shared vision and trust that our investor base puts upon us day in and day out. We value that more than you will ever know, and we'll continue to do what we need to do to protect and grow, your investments, our investments, and our team's investments here at URS Capital. So thank you. And please, if you're interested in working with URS Capital and partnering with us or investing with us, please reach out to Rebecca at urscapitalpartners.com.
Thank you all.
Thanks so much.